What's up, everybody? I just wanted to take a few minutes to provide some commentary on what the Federal Reserve announced yesterday afternoon, last evening, and just to provide some insight as to what it really means with all the jargon that they use, and after I've done some digging to look into what it is that they're going to be doing here and what some of the consequences might be. If you follow me on Twitter, I released kind of a tweet storm, a little thread earlier this morning, which was a little bit of the outline of what I, kind of digesting and distilling my thoughts here, what I wanted to put into a video here. So if you've already seen that, that's kind of what I'm going to be talking about here. The first of which is that free markets they're pretty much dead right now. When I'm talking about free markets, I'm referring to the equity markets and the credit markets. There's no real price discovery anymore. On one hand, you have valuations still pretty high. Today, finally, we have hit, kind of for the S&P 500 at least, we've hit average valuations for the S&P 500 historically. I think 2,400 is the level at which it's around 15. The PE is around 15. Don't quote me on that if I'm remembering that incorrectly, but I think that's what I remember off the top of my head. But that's at current earnings levels. And so what happens when earnings start showing what has happened and over this last couple of months, and we start to kind of get slaughtered there, then we still have a while to go, much further down until we start showing stocks that are at decent valuations, that the prices are cheap. And so that's the first thought, is that we've still got a long way to go. But with that being said, there is a massive fear to short the markets right now, or even sell, because there's rumors that the markets are going to close. There's rumors that the Federal Reserve is going to start buying ETFs and buying stocks directly. There's rumors that there will be a ban on short selling. So all of these things, all this intervention could just completely spike prices again. And so there's a huge fear, especially going into weekends. That's why we've been seeing Friday rallies so hard at the end of the day, because nobody wants to be net short over the weekend. Just, who knows what could happen, what they could announce. So the fear of intervention is preventing real price discovery. And without real price discovery, you don't have free markets. They're just, they're fake valuations. Same thing is happening in the credit markets, because on one hand you have the zero bound has been hit. They lowered interest rates to zero. They can't go below zero because banks won't be able to. It flattens the curve. Banks won't be able to lend. You also can't go below zero because then you risk having a massive unloading of treasuries across the world, because of it would be triggered by hedge funds having to unwind their carry trades really quickly, and so they can't. They're monitoring that. They need rates to be low to allow the Treasury to start their bailouts and to do this the stimulus that they're trying to allow banks to keep their credit lines open. Corporations to access cheap money. And so they're playing a game where they have all of these opposing forces, and so they're trying to, push down and push up in various places all over the credit markets, and they're having a really tough time doing so. And that's why you see such crazy things happening in the bond markets right now: treasuries, investment grade munis, junk bonds, everything. One of the ways that they are influencing these markets is with this new announcement of QE. Now, just as a reminder, QE is debt monetization. Debt monetization is turning debt into money. When debt goes bad, it gets sold off at a discount. Those yields go up, and the person or the entity, the corporation that issued that debt, in order to get new debt, would have to pay a lot higher interest rate. Well, in order to prevent that from collapsing our economy, from cascading across our entire economy and across our entire country, the Federal Reserve is putting a floor under bonds, and they're doing that by directly buying corporate bonds now from banks. So essentially what you have now is the Fed is, instead of just buying mortgage-backed securities, instead of just buying treasuries, they're also buying just regular corporate loans. And so they're the buyers now. And where the free market would have sold those off, they would be sold off at much lower prices and yields would have skyrocketed, they're putting a floor under those. And so whenever you have intervention, you have a misallocation of funds and you have malinvestment. And so that's going to continue, that's going to explode, and that is monetization. That turns into money. And that money, which credit is a form of money, would have otherwise been, essentially destroyed. But they're not allowing it to be destroyed. They're not allowing the recession, which is the cure, to actually, kind of happen on paper. And they're trying to paper over it and not allow those painful but necessary cures to happen in the economy, because this is there's definitely a public health crisis. I'm the first to admit that. I've been telling people to prepare for this since January, when everybody was saying that before anybody even heard about it. I posted my first video about the coronavirus in January before most people had even heard about it. So I'm the first to admit that there are some definite huge public health issues. However, it's a catalyst for the financial crisis. And the reason why the Federal Reserve has been doing things for years that look like they're in emergency mode is because they are in emergency mode. People are wondering why they've been wasting their ammunition, why they've been lowering rates, and why they've been doing these things while markets have been hitting record highs. Well, it's because there's actually been a financial emergency under the radar, behind the scenes, that they're trying to, kind of sweep under the rug. They don't want anybody to find out about. Well, soon enough, you have bubbles big enough, everything becomes a needle, and the coronavirus just turns out to be a pretty big needle. And so we're having, this colliding this colliding group of events coming together all at the same time that's exposing the risk that we've built in our financial system. And guess what? They had to choose between an apparent fiery sudden collapse or papering over that collapse at the expense of the dollar. And they chose the latter, and they always will. Politicians and policymakers will always choose the option that looks less painful short term, even if it's the worst option long term. And so they've done that. They're going to monetize debt and print money to infinity. There is no limit on this. Tax revenues are down. And they're only going to go down even more, and government expenditures are going to explode, and they're only going to go up even more as they deal with the health crisis and then the financial crisis that is falling out as a result of that. And there's no other way to deal with that other than allowing it to take its course and allowing it to happen, and for the recovery to be real. There's no other way to deal with it other than that, and papering it over, printing money to cover it up. It's really debasement of currency. It's devaluing the dollar in order to pay for it. Sorry about the beeping. My car always thinks there's somebody sitting in my passenger seat for some reason when there's nobody there, obviously. I'll wait for that to pass. So that's what's going on right now. They've chosen to sacrifice the value of the dollar, and a proof that this is happening and that the world is about to de-dollar is the fact that they had to open up their swap lines. And so they're giving the rest of the world a very easy way to get rid of their treasuries, because the entire world, everybody's looking at it like it's a dollar crunch. That's not true. The rest of the world wants to dump their treasuries. The only way to dump treasuries is to exchange them for dollars, because nobody else wants those treasuries. The only people that are going to pay for treasuries right now is the Federal Reserve. Nobody else is buying treasuries, only Federal Reserve. So in order to prevent that from being difficult for those treasuries to make their way back to the Federal Reserve through other channels and put downward pressure on the price of treasuries in the meantime, is to open up direct channels to the buyer of last resort of treasuries, the Federal Reserve. So they've opened up those channels, and so they're giving the rest of the world the dollars they want for those treasuries without putting too much downward pressure on the prices to keep yields low. And once the rest of the world has the dollars that they need, they're going to dump the dollars instead. Because if you don't want treasuries, which pay you a small interest rate, why would you want dollars that don't pay you anything, especially knowing that last time this happened, the Federal Reserve was wrong and the government lied, and that they were not able to unwind their balance sheet, and this was not temporary measures, and inflation is going to erode the value of those treasuries and those dollars over time. Why would you keep them? They're not going to keep them. They're going to get rid of them. And the only way to get rid of dollars in a world that doesn't want dollars anymore is to give them to the only buyer of dollars, which is going to be U.S. corporations and U.S. citizens, in exchange for U.S. dollar-denominated assets, products, goods. And so all of the inflation that we've exported overseas for the last mainly decade, but a couple decades before that, is going to come rushing back home, and we're finally going to see the price inflation that is going to be a result of all the monetary inflation that we've exported overseas for the last 10 years. And so, this is what's happening. It's starting with the world getting rid of their treasuries and the Federal Reserve facilitating that through these swap lines. And the next phase of this is going to be the world getting rid of the dollars that they got in exchange for those treasuries. So that is the significance of interest rates going to zero. That is the significance of the Federal Reserve monetizing not only U.S. debt, but all corporate debt as well. And that is the result of the swap lines that they've opened up. And we're going to start seeing some massive price increases. So stay tuned. That's what's happening right now. Stay safe, stay home. Hope you have enough supplies to last if the stores near you aren't fully stocked or don't have anything for you. So stay safe and stay tuned. I'll put up another video as soon as we have some more information. Thanks for watching. Have a good day.